So up next, we're going to look at some blockchain use cases with Quaranta. Matt Liston and Judd Bagley. Tori Adams couldn't make it from Booz Allen Hamilton, but Ron Quaranta from the Wall Street Blockchain Alliance will tell you a little bit about himself and then introduce some of the guys. What they're going to do is share their about 5 to 7 minute presentations, and then we'll have a panel discussions with the group after. So save your questions for the individual use cases until after. So first Ron will go, and then if you want to hold on to that, and then I'll call you up. And you guys hold on to them, and then.
Good morning, everyone. Thank you for being here, and thank you to our friends at Blockchain Conference New York for setting up this event. I currently am the Chief Operating Officer for a company called Loyal, which is leveraging blockchain technology in the rewards and loyalty industry. I also have the deep privilege of serving as the chairman of the Wall Street Blockchain Alliance, as Louis mentioned. The WSBA is a nonprofit trade association focused on advocacy and the adoption of distributed ledger and blockchain technology across financial markets. We do that through education, advocacy, and thought leadership within the organization itself. One of our recent developments I thought I'd share, we just launched the WSBA certification framework, which is meant to be a comprehensive education curriculum working with our partners at Positrust Technologies. And shameless self-plug, you can find us at www.wsba.co. We're going to change up the format a little bit of this particular panel. I'm going to spend a moment just introducing each of our panelists, give them the 60 seconds to describe a bit about their background, a bit about what their company is doing, and then we're going to go into slide presentations for each of their offerings so that we understand that we've gone beyond theory in the blockchain world, that there are live use cases that are worthy of consideration and worthy of sharing within the industry itself. So first, let me just introduce briefly Judd Bagley, Director of Communications at Overstock and the Chief Evangelist at T0.com. We also have Jay Kwon, who is the founder and CEO of Tendermint. And finally, Mr. Matt Liston, who is the Head of Strategy and Communications for Gnosis. So Judd, do you want to spend a moment or two talking about T0 and Overstock?
Yeah, so a question I get asked all the time is what on earth is Overstock.com doing working in this space? And I should give some context. In January of 2014, we became the first major retailer to accept Bitcoin as a currency and accept Bitcoin as a form of payment, and in the process became aware of blockchain technology. Overstock we're a Utah-based company, and we have a real kind of a history of butting heads with Wall Street in terms of some settlement practices, which I'm going to be getting into in my presentation. But in the course of learning about Bitcoin and comparing it to some of the concerns we had about the Wall Street infrastructure, we came to the conclusion that blockchain technology could be applied as a solution to this problem. And so we developed a financial technology subsidiary, which we call T0. And so that's what brings me here. We've created a platform for the exchange of digital securities. And I'll be, again, explaining more of that soon. But that's what brings us here.
Great. Jay?
Hello. Hi. My name is Jay. I'm here representing two entities. One is Tendermint, and the other is called Cosmos. And I'll go into that in a bit. Tendermint is an open source and free blockchain engine. It solves one very simple component of this whole blockchain system, namely the consensus part. And so what Tendermint does is it allows anyone to create their own blockchain system. It solves things like networking, transaction broadcasting, and it has a robust Byzantine fault-tolerant consensus algorithm built in. So what that is it's really just an alternative to like Bitcoin's proof of work. It doesn't require proof of work. It uses a completely different mechanism to secure the ledger. Okay, so and Cosmos is something else entirely built on Tendermint, but I can get into that later.
Great. And how about you, Matt?
Hi, I'm Matt Liston, here representing Gnosis, Decentralized Prediction Market, and Consensus. So Gnosis is a decentralized prediction market built on the Ethereum network. For those of you who don't know, a prediction market is sort of a generalization of financial markets, speculate on the outcome of really any decidable event. We also provide an Oracle marketplace. Oracles are important in the context of smart contracts when you need to get information from the external world on-chain. I'll be talking about the wide variety of use cases for a decentralized prediction market, everything from financial instruments to forecasting to governance and insurance.
Perfect, thanks. And I think we'll start, Matt, with you if you wanted to come and do your particular presentation. I would ask the audience to kind of hold questions towards the end if we could so that they can all get through their value proposition decks.
Oh, my mic. Cool, thank you.
PowerPoint?
That's good.
You double mic there, so
Oh, should I turn this one off?
maybe,
So as I mentioned, I'm here representing Gnosis. So first, let's take a look at what a prediction market actually is. So in a prediction market, anyone, anywhere can buy and sell shares in the outcome of any event. An example is, will Hillary win the 2016 general election? So the prediction market would create shares in yes and shares in no. Each share pays out 1 in whatever token the market's denominated if that corresponding outcome occurs. And the price of each share represents the probability estimate that outcome will occur. So if the price of a no share is 0.2, then there's a 20% chance, according to the market, of Hillary actually winning the election. So a good example of an informal prediction market occurred when the DAO fiasco was happening. So after the DAO hack, there were markets exchanging DAO for Ether. And at one point, the price of that exchange rate was 0.00785, whereas in the initial creation period, it was 0.01. So what this is representing is the market's estimate that there was a 78.5% chance of this being remedied, probably through a hard fork. After the hard fork actually occurred, it was then certain that these DAO shares could be redeemable for their 0.01 price, so the market reflected that. So why are we using Ethereum? Well, there's a couple reasons. One advantage for providers is that we're no longer custodian of funds. So funds are held in smart contracts, sort of an on-chain algorithmic escrow. For the user, this also means that they don't have to trust us and there's no counterparty risk. And for all of us, it's censorship resistant, so it can run as a protocol layer for this global liquidity pool for prediction markets and deal with regulation in each individual jurisdiction at the application level. In the long term, this is all really important that it's an open platform. So currently with most even peer-to-peer applications, it's a data silo model. So if I want to come in and build an application on top of this network, I want to know that the data is going to behave in a year exactly how we expect it to. So with a smart contract decentralized application, we can make those types of guarantees. And it's our thesis that by doing this, we can get many, many applications building on this one global liquidity pool, leading to better pricing and lower fees. So the really cool part of prediction markets is the wide variety of applications you can build using them. Everything from gambling and financial instruments, information and forecasting, insurance and hedging, action incentives, and governance or decision making. So first, let's take a look at financial applications. You can do some interesting things. One is markets on specific stock fundamentals. So instead of asking what is the Apple share price going to be at a particular date or buying and selling the actual share, you can ask what is Apple's Q4 revenue going to be. So you get a very fine-grained model of this. You can also replicate existing instruments, binary options, or sort of pegged assets or stablecoins, offer these to new markets. And another interesting thing you can do is conditional markets. So in this case, what will Apple's share price be if over 20 million iPhones are sold in Q4? The most widespread application for prediction markets currently is betting. So, in the UK or EU, this is licensed prediction market betting exchanges. Prediction markets in a general sense are more interesting because it's not just limited to sports events, it extends to anything, politics, for example, or science. One previous really interesting use cases that governments and corporations have used it for is information aggregation and forecasting. So for instance, if a government wants to know what is the expected harvest in this region, or another example that actually occurred with us is some researchers from university came to us saying, hey, we'd like to have prediction markets so that our machine learning models can give their input on whether there will be lead pipes in each Flint housing parcel. So another interesting application is insurance. Here, you actually create a market for each risk event. So for example, will this flight be canceled or delayed? The market then gives you a probability of this occurring. People can buy and sell shares. And the way you create the actual insurance contract is you have a smart contract. People send the smart contract money. And the smart contract then buys yes positions in the risk event. So if that event actually occurred, in this case, flight delayed or canceled, that smart contract, because it owns the yes shares, will have a high payout from that, which it can then pass on to the insuree. A really weird one is action incentives. So there's actually a feedback loop between these markets and creating an incentive to affect the actual outcome of the market. So a cool example of this is sort of a crowdsourcing of software exploits. So for example, Apple makes a market asking, is there a zero-day exploit in my piece of software? And then they will go into the market and buy many, many no shares. What this does is it makes it very cheap for someone to come along and buy yes shares. So a researcher finds an exploit, buys $100 of yes shares, has a $10,000 payout, and then reveals the exploit. So one thing that I've been doing research in, and we're also using for our Gnosis DAO, is something called futarchy. So this is prediction market-based governance, where the market actually decides what sort of legislation is going to pass or not. So in this case, a cool example is you have a corporation deciding if they should fire the CEO or not. So they could create two markets. One market says, if we fire the CEO, what's our share price going to be in 6 months? Or if we don't fire the CEO, what's our share price going to be in 6 months? So in this setup, the market or the action is taken corresponding with the higher market estimate. So if there's a higher expected share price, if the CEO is fired, the CEO is fired. Then the people who participated in this market essentially have a stake in the decision they implemented. So if it wasn't accurate that the share price would be higher, they lose money and vice versa. So what does Gnosis do exactly? Well, at the core, there's these markets, which are smart contracts existing on the Ethereum blockchain. These price shares, redeem shares, and allow people to buy and sell them on-chain. In addition, we're building off-chain trading, sort of a more technical concept, but essentially it allows for very frictionless trades, so high speed and low transaction cost. Sort of the other main component is our Oracle market. So here, an Oracle is required in a prediction market for the settling of any event. So if there's a market on will Hillary win the election, someone needs to come and input that data securely into the blockchain. So here we allow anyone to sign up to provide Oracle services, and this can not just be used for prediction markets internally, but really any smart contract that needs oracles. We also believe that it's really important to just build a core platform and liquidity pool, but also make it very easy for anyone to build their custom applications on top of it. Because of the wide variety of prediction market applications, it's very important to have a unique user interface, marketing strategy, regulatory strategy for each application. Finally, we're having a crowd sale. It should occur around DevCon 2, which is September 19th.
Thank you, Matt. Jay, I believe you are up next.
Sweet. Great. Hello? Hi, so I'm going to talk about two things. First, I'll start off with a brief introduction of Tendermint and what it's supposed to do. And then we'll get into some crazier stuff. So Tendermint started in 2014 when I looked at Bitcoin and got really excited about it, but I did some calculations and realized that the proof of work mining component of Bitcoin isn't the best, and maybe I was hoping that we could do better. And ultimately found the solution when I dug through academic papers on Byzantine fault-tolerant consensus algorithms. And so Tendermint, its mission is to bring that research into practice so that everyone can use it and everyone can build on top of it. And it's not like I'm not just being philanthropic, right? By sharing a common core, we can all share the cost of maintaining it, of making it robust. So it really makes sense. That's why we made it free and open source. So I've been I'm a programmer with some computer science background, so that's why I'm doing this. It's very fun. So what are blockchains? I mean, I think we all know what it is. It's about several different fields coming together. I like to call it crypto economics. So when I say Byzantine fault tolerance, what I'm talking about is a different. It's not just about fault tolerance. Like Google and Facebook, these companies use Raft and Paxos to create robust fault-tolerant systems, but those algorithms are not designed to accommodate failure due to malicious hacking or failure where the operator of that machine is trying to disrupt the entire system. For that, you need Byzantine fault-tolerant algorithms. Bitcoin was the first widely deployed use example of a BFT ledger, and that's partially why it's so exciting. Bitcoin is being attacked constantly from within, and yet it continues to function just fine. That's because it's fault-tolerant. Okay, but there's another way to solve the same problem without using mining, and it's using what I call classical BFT algorithms. I call it classical because it came before Bitcoin, and it started even before the 80s with Leslie Lamport and many others. Basically, it's about using public-private key cryptography, so the same thing that is used behind Bitcoin accounts, but using those for the process of committing blocks. So all the actors who are committing blocks are pseudonymous, and they're in a set that is responsible for committing blocks. And there's a certain algorithm or a protocol that ensures certain guarantees. The guarantee is kind of stated here. The guarantee is that the system will only fail if a third or more try to disrupt the system. If a third or more of the entire set of validators get hacked or coordinate an attack. The other nice thing that we kind of introduced with Tendermint is that once there is an attack, the attackers can be found out, they can be identified and held accountable. So by combining these properties, and of course with collateral. So it's not sufficient to identify those pseudonymous attackers if they have nothing at stake, if they already sold their voting power to somebody else. So what you need to do is make sure that their voting power or their tokens that give them that voting power are frozen and held at bond. And you can even do it on the blockchain. So when you combine these three properties, you get a different way to secure a distributed ledger. And that's what Tendermint is about. Tendermint works for consortium or private blockchains, but we also we're designing it with the intent of making it useful for public blockchains as well. The nice property of, what's nice is that it's much faster. Like, we don't have to wait an hour for a transaction to fully commit. It can happen in as soon as a second or sub-second, or 3 seconds for a global distributed ledger. It's much more energy efficient and potentially much more secure. So that's Tendermint. It's open source. It's there. It already exists. We're about 90% done with it. Now what we're going to do is build on top of Tendermint to create something even more ambitious. And we're calling it Cosmos. There's a GitHub account because we don't have a website up yet, but okay, I'll continue.
That wasn't on purpose.
Cosmos is about a network of ledgers or a network of blockchains. I'm going to call the blockchain a zone. I like that term better because a blockchain is sort of its own. It has its own governance policy, or it should. It has its own economic policies. For example, how coins in that system inflate. What to do in the case of theft. For example, with ETH, Ethereum, they've decided that, hey, in the case of huge theft, we should roll things back. Whereas in Ethereum Classic, they've decided to, go for immutability. Once it's stolen, too bad. These are all governance or economic policies, and each blockchain should have their own. So, I believe that a public blockchain should start with a constitution or a prior social contract. Bitcoin has one. We all know what it is, right? It's immutable. It shouldn't. Transactions should never be rolled back. That's fine, but maybe what we need for a more wider scale deployment is something that can be rolled back or managed with trusted actors, perhaps. But in any case, there's a lot of room for experimentation. With Tendermint, we've developed a nice trick that allows blockchains or zones to be able to communicate with each other directly. So this is using like client protocols, and I can kind of get into it. It's not being done today very well. This is what Blockstream is trying to do with sidechains, but briefly, it's about taking the proof of the internal state of a ledger and turning that into a transaction that can be processed by another blockchain. Now you can have two blockchains that can directly communicate with each other. So what can you do with this? For example, you can scale out Ethereum. So Ethereum has a scaling problem today. It's only one ledger. It's limited by the resources of basically one computer, even though it's distributed because they're all doing the same thing. But if you have many independent Ethereum ledgers, all connected through a central hub, and the hub manages how many tokens is in each zone, and for token movement if you require that all token movement happens through the common hub, then you have a system that can scale Ethereum. Another nice property of this is it makes it really easy to upgrade the logic or the smart contract system itself. Like if there were Ethereum version 2 or version 3, new virtual machines, they can all be plugged into this hub, and people can just move tokens into it whenever they want. Another nice thing is we can import like other distributions like Bitcoin or Dogecoin or whatever, or we can even import the applications themselves. Basically what I mean is Tendermint it makes it really nice to be able to replace the proof of work consensus mechanisms of existing blockchain stacks with Tendermint, the proof of stake consensus algorithm. And they can all plug into Cosmos Hub. Now we can have a distributed exchange where you don't have to trust a central exchange to, like what happened to Cryptsy, right? We can do away with that. All we need is better technology. The nice thing about Cosmos is that it's not the center of the universe. We're really trying to create a protocol or an architecture that is suitable for the future, forever. The hub can even connect to other hubs. Other hubs may become more dominant in the future. That's the kind of thing we're trying to build. So that's it. Check us out. We're also going to have a crowdfund in October. This is a public blockchain, so I think a crowdfund is suitable for that. Check it out. Thank you.
Thank you, Jay. Judd, the stage is yours.
Oh, thanks. Was that too long? I wasn't counting.
So again, my name is Judd Bagley. I'm Chief Evangelist at T0. There I am on Twitter and LinkedIn, so feel free to connect with me if you want to continue the conversation. I want to start by giving a little bit of context as to the nature of the problem that we're trying to solve. I think the best way to do that is to go back to October 23rd of 2008. This was shortly after the big financial meltdown that so affected this part of the country. Before Congress, former chairman of the Fed, Alan Greenspan, was asked to give his impressions on what happened. And he said, okay, we're on a Mac, so this isn't working. He said there are additional regulatory changes that this breakdown of the central pillar of competitive markets requires in order to return to stability, particularly in areas of fraud, settlement, and securitization. So fraud, we all know, that's Bernie Madoff. That was part of what happened. Securitization, this is the mortgage-backed securities, for example. Everybody knows what that was all about. But a lot of people were confused what settlement was about. So I'm going to talk a little bit about settlement. Settlement is basically everything that happens after you place your order. And this is how the asset gets from me to you, and the money gets from you to me when we make a trade. Now there's a book, and I used to carry this around as a prop, but it's too big and too heavy. It's called After the Trade is Made. It's the Bible of this stuff. That shows you how thick it is. It's 500 pages long, and this is the book that describes how the asset gets from me to you and how the money gets from you to me. And basically, I can just boil this book down. What the book is talking about is what processes are in place to ensure sufficient balances, so to make sure that I have the asset that I claim I do, that you have the money you claim you do, how to keep me from being able to double spend so that the asset can only be spent once and the money can only be spent once. How to assure timely delivery of the asset and the money, how to minimize ledger tampering, and how to create an audit trail afterwards so that everybody can agree on what happened. Okay, keep those 5 things in mind as I go on. So basically, the problem is that in settlement, you have like in the investor and the hedge fund, right? And so they want to exchange, and by hedge fund, I mean like, any market participant, but Gordon Gekko's a convenient foil. The problem is that the two halves of settlement are divorced in America. So you have one that takes place and then the other that takes place. In that gap, there's a lot of opportunity for mischief, and I'm going to explain why that is. Because it's not like the investor and the hedge fund actually trading. They have broker-dealers that operate between them. But it's even a little more complicated than that, because you have operating in between them an organization called the Depository Trust and Clearing Corporation. So all these trades happen through the DTCC, but it's actually a little more complicated than that, because it's a big hub and spoke system, and so everything happens through this one organization, but actually everything happens within that one organization. So you have all the trades happen within accounts inside the DTCC. And it's even a little more complicated than that, because like what happens is if I sell you 100 of something and you sell me 75 of something, they just net it out at the end of the day for the sake of simplicity. And instead, I just send you 25, okay? And again, so when you have a centralized organization that uses net settlement, you have a lot of opportunity for mischief and inefficiencies to take place. Complicating things are the fact that this DTC is a big black box. Nobody really knows what happens inside there. It's owned by Goldman Sachs, JP Morgan Chase, and those guys. So with Wall Street, you have basically centralized net settlement, high-frequency trading, and a regulatory environment, which lend themselves to manipulation, front-running, and capture. Capture is a state of human nature, which basically refers to the fact that when you have a regulator, the regulator basically ends up kind of operating at the behest of the large entities that it's supposed to regulate. So it becomes more of a tool for the large entities to maintain their market position, okay, at the expense of everybody else. Okay, so the simplest solution, and I probably should have thought before I brought this slide, given the location, but we've decided that the simplest solution is to take Wall Street behind the barn and kill it with an axe. And so, you know, just like they say only Nixon could go to China, only a Utah company could make this suggestion, right? Yeah. 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 So the virtues of blockchain-based settlement are there is no manipulation because this peer-to-peer settlement actually is able to take place. There's no front running because this is a system that's completely egalitarian, and there is no regulatory capture because this is a consensus-based and stateless system. So true settlement with the ledger, when I say true settlement, this is actual gross settlement. So this is for every share that's traded, there is an actual movement of the asset and the cash from one balance, from one wallet to another. None of this netting. So the way that works is when everybody has a wallet with two balances in it, stock and the asset, and you simply erase the balance from one and credit it to the other, erase the balance from the other and credit it to the other. So it's very, very simple, low friction, okay? So the way this would work is the national market system becomes replaced by ledgers that are cryptographically protected, like this. Okay, so what is the blockchain really good at doing? It's really good at ensuring that there are sufficient balances in everybody's account, that there's no double spending, that there's timely delivery, there's minimal ledger tampering, and there's an audit trail that makes it so everybody can agree on what's happening. Does that ring any bells? Okay, so this is precisely what that book I showed you takes 500 pages to accomplish. The blockchain makes it, using cryptography, makes it very, very easy to accomplish. This is what T0, we call it T0, by the way, because currently on Wall Street, it takes 3 days to settle trades. You go through all those processes, it takes 3 days. That's called T+3 or T3. We call it T0 because we figured out how to do it in about 10 minutes. And for about 20% of what it costs to do. So friction dramatically reduced, friction in terms of time and money. So it's no longer just a theory. Last year, Overstock.com issued a corporate bond and sold it to a company called First New York Securities. And it was just as simple as them sending us the money, we sending them the asset using the blockchain. This shows you, these are the actual trades. Those of you who know how to navigate the blockchain can see these are the trades by which the money changed hands, the asset changed hands. So the whole thing was executed, cleared, settled, and unwound entirely on the blockchain. So it's no longer just a theory. In December 2015, the SEC deemed Overstock.com's application to issue shares, a secondary stock offering, entirely on the blockchain effective. So that was deemed effective, and then we will be the first to do it. We've announced that and that's something we're working toward very diligently right now, is figuring out how to issue shares entirely on the blockchain to allow you guys to trade them back and forth directly with one another. And it will basically it'll be like that. Okay, got it, thanks.
Thank you, Judd. Thank you all. I noticed in the audience just a couple of observations. The folks laughing loudest and longest when they saw the axe imagery have probably been on Wall Street longest. And all the technologists in the audience looked at that and said, is that really how Wall Street works? So a couple of questions real quickly. You all have relatively sophisticated offerings. One of the challenges that we've seen in this space for at least the last couple of years has been what I call the education curve. Getting our clients, getting our prospects to understand the value add of what we're doing in the blockchain space particularly. I wanted to ask across the panel here, how have you been speaking to customers and prospects, and how are you meeting those education challenges? Judd, let's start with you.
Gee, I, so one of the most interesting audiences that we've had to deal with through this has actually been regulators, if I can just kind of address that. The way this works is, so Overstock, we submitted our S3, which is basically telling the SEC we intended to issue shares in purely digital form using blockchain technology. They then send the thing back with a bunch of questions that we answer in the form of amendments to the S3, which they then send back with questions when we respond, and it goes back and forth like that. When we initially submitted our request to do this, the questions that came back made it apparent that we caught the SEC completely flat-footed. Like they had no idea. They were confused about things. They were wondering about like Mt. Gox, and it was apparent they didn't know what we were really talking about. By the time we were done, and it took 5 cycles, their level of understanding of this had increased dramatically. I mean, they were clearly taking this very, very seriously. So the education curve there was a little steep, but we were quite encouraged to see that the regulators responded very, very admirably, and this is something that they want to make happen. As for actual market participants, everyone kind of, blockchain is one of those kind of magical words like cloud. You can say, and immediately people become interested and figure out, we need to have a blockchain or something like that. So there's a lot more interest there because of events like this, and filters up to these folks. And but it has been it has been a challenge. However, the field is white, and everyone's really eager to kind of to figure this out, so that's encouraging. So it's no longer a case of trying to explain why there's a problem. Everybody gets that. Now they're trying to figure out how this relates to them and how they can make it work in a regulatorily appropriate fashion.
Right. Jay, how about yourself?
So for Tendermint, we try to explain the virtues of like T0 settlement using blockchain technology. But being technology creators or technologists and not having any financial background, penetrating that market was difficult. So we decided to focus purely on the technology instead. And most of our customers are other startups with technical members who can talk to us on our Slack channel or visit our GitHub page so they can read the resources that we put out there. I mean, most of our communication and education is done through our GitHub projects. For Cosmos, we're going to have to do something different because it's a particular product built on Tendermint. So we will start having more. We'll have discussions and conferences for Cosmos, but also we'll reach out to partners and regulators, and also want to mention that we're interested. There's a lot of use cases for Cosmos, and just come reach out. It's that simple.
Thanks. And Matt, how about you?
So for us, it's a bit opposite of what Jay is doing. I think the first thing is it's been useful for us to detach the actual use cases from the blockchain, so people don't really have to understand what's going on in the blockchain whatsoever. Then from there, the first challenge is just getting people to understand the general concept of prediction markets. And then from there, it's usually interesting to see everyone's interested in a different use case. So here, it might be people interested in financial use cases or insurance use cases. In the blockchain space, people get really excited about futarchy. And then, potential investors who are just interested in like a simple revenue model usually look for the sports betting. So for us, it's about detaching it from the tech stack as much as possible, and then focusing on individual use cases for each person we're talking to.
Great, great. Matt, let's stick with you. Jay started talking a bit about who his customers are, without giving names, certainly, but what types of customers, what types of prospects are you looking at, and how are you approaching them specifically?
Sure. So probably the most noteworthy are sort of larger financial firms and research firms who are interested in initially using sort of that concept of markets for very specific fundamentals to both directly sell their research and also create better models for like more efficient financial markets. So we're working with several big firms there. One of them that I can publicly say is Wedbush. Then there's sort of like experimental edge cases. A lot of like smaller startups have come to us and said, hey, you're building this futarchy solution. We think this is crazy and the future of everything. Can you help us implement this? And then, there's sort of like the end users who are just interested in, hey, can I use my Bitcoin to speculate or forecast whatever event?
Thanks. Judd, how about you? Customers and prospects, what types, what portions of the industry are you targeting? How are you approaching them?
So we're two levels. There are stock issuers that we are targeting. We're paving the way legally and regulatorily for others to be able to issue shares on our platform. We're starting with existing public companies such as Overstock.com that can issue onto this, but we think that probably the real killer application of this will be so companies will be able to access public equity markets that are not large enough to do so currently. They'll have access to our market. So sort of a real enhanced crowdfunding that way. We're also offering the software to actual markets that want to use it to enhance the speed and their capacity to settle trades quickly and efficiently and at lower cost. It doesn't appear that it's going to be domestic markets that are going to be the first ones to use this. The interest is overwhelmingly overseas, and in places like Singapore, Dubai, areas like that. So that's those are the two, and then the consolidated audit trail functionality is something that we're also going to be working with regulators, also issuers, also exchanges. So yeah, we're sort of hitting this in three different ways.
Great, thanks. So I realize we're running a bit short on time. I did want to open the floor to some questions. One or two? Yep, we'll keep it brief.
I can ask. Mr. Bagley, how would you reconcile what the SEC did in approving your S3? And I have read the back and forth. With a gentleman on the prior panel who talked about what he was doing with Delaware and what he needed to get done out of Delaware. I'm not sure I understand how that reconciles with the SEC's approval of your S3.
We haven't dug into the Delaware project too well, to be able to answer that. But we think it will, if anything, what the Delaware project is to us, why we find it important, is it represents a change in thinking in ways that if an entire state adopts this new technology, it's going to leave other entities, SECs, regulatory bodies here and in other countries. It stamps kind of it gives this technology a sort of legitimacy that's going to,
SEC has already said that you could have digital securities.
And the Delaware project is another year before that comes.
So does that mean that you would not issue digital shares now because you have a Delaware problem, or?
Oh no, we don't. It's not no. We don't. We started this process before we even knew about the Delaware project, and so so we don't see this. It doesn't get in the way. If nothing else, it represents kind of a cultural change that we think is going to kind of grease the gears, in the favor of this kind of thing generally.
Yep, let's move on. We're really tight on time. One more question. In the back.
Sorry, yeah, this is a question for Judd, because I've often found it a little bit bizarre that the United States is home to Silicon Valley and Google and Amazon and Facebook and these titans of technology. As far as I'm aware, and I'm happy to be corrected if I'm wrong, but for years Asia would settle stocks T+1. In Europe it was T+2. The United States of America, home of Silicon Valley, it wasn't until about, 6 months ago or something that it went from T3 to T2?
It's not even there yet.
Well,
Yeah.
why is that? I mean, I have my own theory, but I want your opinion because you would know.
Well, so our theory is also the problem of incumbents. So the same people that would make these changes are the same people that belong to the same racket clubs and et cetera, with the same people who stand to lose from these kinds of changes. So that's just it. That, again, like I said, I think that's why it takes a Utah company with no ties to these folks to propose a system that is going to disintermediate them. That's what I think.
Let's leave it there. Apologies, we're out of time. There's a lot to dive into here, plus we have to get you all fed. So please join me in thanking the panel.
And thank you, Ron. Hope you